Welcome to the New Insurance Contracts webinar on IFRS 17, Recognition and Derecognition Requirements. This webinar is part of the series that the IASB is producing to support the implementation of the New Insurance Contracts Standard. My name is Maria Karamanu and I'm a Technical Associate on the Insurance Contracts project.
My name is Joanna Yeo and I'm a Senior Technical Manager on the Insurance Contracts project.
Before we start, as usual, the views expressed in this presentation are our own, not necessarily those of International Accounting Standards Board or the IFRS Foundation. A copy of the slides used in this presentation is available for download through the website. Those slides are accompanied by additional material that we hope you will find useful. We have previously published several webinars on IFRS 17 to support its implementation. These are available on our website. This slide shows how this webinar fits in with the other webinars on IFRS 17. You may also wish to listen to the previous webinar on the scope of IFRS 17 first, to decide whether contracts are within the scope of IFRS 17. In addition, I'll highlight portions of this webinar where it would be useful to listen to previous webinars. Today, we will cover the IFRS 17 recognition and derecognition requirements for insurance contracts. The pre-recognition period is the period before the recognition of insurance contracts. Although it is not used in the standard, the webinar will use the term pre-recognition period for ease of explanation. Today's webinar focuses on the recognition and derecognition of insurance contracts for all contracts within the scope of IFRS 17. There are modifications to the recognition requirements for reinsurance contracts held to reflect that the reinsurance contracts are acquired rather than issued. If you are interested, our previous webinar on reinsurance contracts held covers those recognition requirements.
We will start with an overview of what happens during the pre-recognition period, in other words, during the period before the normal recognition of insurance contracts. Insurance contracts are normally recognized at the earlier of the beginning of the coverage period or when premiums are due. The insurance contracts are measured under IFRS 17 only when they are recognized. Before insurance contracts are normally recognized and measured, a company will need to consider the following 3 points. Firstly, a company assesses whether the issued contracts are within the scope of IFRS 17. Secondly, a company accounts for any insurance acquisition cash flows. And thirdly, a company recognizes any onerous contracts earlier than the normal recognition date. The next slides discuss these 3 points further. Let's start with the IFRS 17 scope assessment. A company assesses whether any issued contracts are in the scope of IFRS 17. As a high-level reminder, the scope of IFRS 17 includes insurance and reinsurance contracts issued, reinsurance contracts held that are acquired, investment contracts with discretionary participation features. A previous webinar on the scope of IFRS 17 is available on our website, which may be helpful on this point. Once the company has assessed whether contracts are within the scope of IFRS 17, the company may need to perform further assessments for some contracts on the inception date. The inception date is when the company accepts risk arising from the contracts. If the company has eligible contracts, the company will need to decide if it wishes to apply the simplified approach, that is the premium allocation approach, at that inception date. You may be interested in listening to our webinar on the Simplified Accounting for Contracts with Short Coverage Period available on our website. If a company has contracts with participating features, the company will need to assess whether a contract meets the definition of an insurance contract with direct participation features. A company with specified contracts without direct participation features will need to specify the basis on which the company expects to determine its commitment. If insurance acquisition cash flows are paid or received on or after the related insurance contracts are recognized, they are considered in the measurement of those contracts. However, some insurance acquisition cash flows are paid or received before the related insurance contracts are recognized or even issued. In this case, those cash flows are recognized as an asset and liability and are presented with the carrying amount of the related group of contracts. Please note that there is a practical expedient that simplifies the accounting treatment for the acquisition cash flows for contracts that qualify for the premium allocation approach. Again, you may be interested in the webinar that's available on our website on that approach. When does a company normally recognize and measure insurance contracts? It normally does so after the inception date. The inception date is the date the company accepts risk from those contracts, and we explain normal recognition a little bit further in the next slides. However, a company may recognize insurance contracts on the contract's inception date or during the period between the contract's inception date and the normal recognition date in certain circumstances. We call this early recognition in this webinar. A company uses early recognition when facts and circumstances indicate that a group of insurance contracts are onerous. If a company has chosen to apply the premium allocation approach to eligible contracts, there is a simplification in this regard. If facts and circumstances do not indicate that insurance contracts are onerous, then those contracts are recognized normally. The next slides explain what we mean by normal and early recognition in further detail and shows examples on how to apply those requirements.
So, when does a company normally recognize and measure insurance contracts? It does normally after the inception date. For profitable contracts, the normal recognition for those contracts is at the earlier of the date of when the coverage period begins and of the first payment due. As explained on the previous slide, if facts and circumstances indicate insurance contracts are onerous, the company recognizes those contracts earlier than the normal recognition date. Again, another consideration is the level of aggregation or unit of account. As explained, we plan to have a future webinar on this. Let us proceed to a few examples that illustrate the normal recognition applicable to profitable contracts and early recognition applicable to onerous contracts. Let's start with example 1 on profitable contracts. We assume that there are no facts and circumstances that indicate those contracts are onerous. Let's further assume that all these contracts belong to the same profitable group based on IFRS 17 level of aggregation requirements. In this example, as you can see, on 1st of July, the insurance contracts are incepted or issued. That is when the company begins to accept the risk from this period. The 15th of July is the beginning of the coverage period. The 30th of July is when the policyholders' payments are due. In other words, when the premiums are due. The beginning of the coverage period is earlier than when the premiums are due. Therefore, the insurance contracts are recognized on the earlier date, which is the beginning of the coverage period on the 15th of July. On initial recognition, the group of insurance contracts is measured. In this example, these contracts are profitable, and the IFRS 17 measurement requirements result in no day one gain being recognized. A previous webinar, Measurement Essentials of IFRS 17, explains the measurement requirements in detail if you are interested. Let's continue with another example on a group of profitable contracts. In this example, the date the premiums are due is earlier than the beginning of the coverage period. On 1st of July, insurance contracts are incepted or issued. On 15th of July, premiums are due. On 30th of July, the coverage period begins. So when does the company have to recognize those contracts in this case? In this case, the recognition date is the 15th of July, which is when premiums are due, because the premiums due date is earlier than the beginning of the coverage period. As in the previous example, there is no day one gain recognized. On the recognition date of 15th of July, the group of insurance contracts is measured. Let's see now what happens when a company has facts and circumstances to indicate that insurance contracts are onerous. In this example, on 1st of July, the insurance contracts are incepted or issued. On 15th of July, the company becomes aware of facts and circumstances that those insurance contracts are onerous, and according to the level of aggregation requirements, those contracts are a group. On 30th of July, the coverage period begins and premiums are due for those contracts. In this example, the group of insurance contracts is recognized on 15th of July, which is prior to the normal recognition date of the 30th of July. Accordingly, on the recognition date of 15th of July, the group of insurance contracts is measured. If there is a day one loss, that day one loss is recognized immediately in profit or loss. A previous webinar, Measurement Essentials of IFRS 17, explains the measurement requirements further.
The previous slide discusses when a company writes or incepts insurance contracts with policyholders. However, sometimes a company acquires insurance contracts when it acquires a business in accordance with IFRS 3 business combinations, or when it acquires a group of insurance contracts from another company that occurs outside of a business combination. When a company acquires insurance contracts from another company, what is the acquirer's date of inception and recognition? For the acquirer of the insurance contracts, the transaction date is the inception date of the newly acquired insurance contract. The premiums are deemed to be due on the transaction date, and therefore the acquired insurance contracts are also recognized and measured on the transaction date. For a group of insurance contracts acquired through an IFRS 3 business combination, the transaction date is the acquisition date of the business combination. As a reminder, on the recognition date, IFRS 17 requires a group of acquired insurance contracts to be measured using the consideration received or paid, which is the fair value of the group of contracts at that date as a proxy of the premium.
As explained before, a group of insurance contracts is measured on the recognition date using the assumptions on that date. In addition, the insurance acquisition paid or received and previously recognized as an asset or liability in the pre-recognition period is now de-recognized and considered as part of the measurement of the related insurance contracts when the contracts are measured on recognition. The insurance contracts are remeasured until they are de-recognized. We explain in the next slides when derecognition occurs. The insurance contracts are normally a liability that is remeasured over its life at every reporting period until it is derecognized. The carrying amount of a group of insurance contracts is the sum of the liability for remaining coverage and the liability for incurred claims. Both are the obligations to investigate and pay valid claims for insured events. The distinction between them is whether the insured event has occurred or not. For more details on the initial and subsequent measurement of groups of insurance contracts, please listen to the webinar on measurement essentials available on our website.
When does a company derecognize insurance contracts, i.e. when the company is no longer required to measure those contracts and have it on its balance sheet? The next slide discusses the IFRS 17 derecognition requirements. A company derecognizes an insurance contract when all rights and obligations arising from that contract are extinguished. When are those rights and obligations extinguished? This happens when the obligation has expired, been discharged, or cancelled. In some cases, a company may purchase a reinsurance contract to cover the risk of the underlying insurance contracts. However, a company cannot derecognize the underlying insurance contracts simply because it has purchased reinsurance contracts. A company may also derecognize an insurance contract when a specified term is modified. For example, when there is a change agreed between the parties of the contract or when there is a change in regulation. Sometimes an insurance contract has options as part of its original terms. The exercise of such an option that is already included in the original terms is not a modification and therefore will not result in derecognition. In the next two slides, Maria will explain further which modifications will result in a contract being derecognized.
So, under IFRS 17, a contract is derecognized if the accounting of the contract would have been significantly different had the new terms always existed from the inception date. The following new terms constitute modifications that result in derecognition. If the new terms mean that the contract would have been outside the scope of IFRS 17, or if the new terms mean that different non-insurance components would have been separated, or when there would have been a substantial different contract boundary. For example, the new terms would have substantially changed the cash flows included in the measurement of the contract, or when the contract would have belonged to another group instead of the group it used to belong prior to the modification. Additionally, the following new terms also constitute modifications that will result in derecognition. If the new terms mean that the contract now meets the definition of an insurance contract with direct participation features, whereas previously it did not, and vice versa, or when the contract is no longer eligible for the premium allocation approach when previously the company chose to apply the premium allocation approach because the contract was eligible. If the new terms meet any of the criteria in this slide and the previous slide, the entity derecognizes the contract. The company will need to recognize a new contract if the new contract is within the scope of IFRS 17. In this case, the modification date is both the recognition and the inception date of the new contract.
During this webinar, we have discussed when insurance contracts are recognized and derecognized. We also discussed what happens during the pre-recognition period. We hope that you found it useful. As stated before, We intend to produce future webinars and other materials to support the implementation of IFRS 17. Please visit our website for the existing webinars that were mentioned in this webinar. Thank you and goodbye.
Thank you.